Hey everyone, welcome back to the channel. Today, we need to talk about Intel because something very interesting is happening right now. For the past few years, Intel has been one of the most criticized companies in the stock market. People said they were falling behind. People said the turnaround was too expensive. People said the company was losing relevance. And honestly, there were real reasons for concern. Losses were piling up. Debt levels were elevated. Cash flow was under pressure, the dividend was cut, and investors were wondering whether Intel could truly recover. But now, the story is starting to change because Intel's business is improving, demand is rising, orders are strengthening, and momentum is returning. But there's one major issue. At the exact moment demand is improving, Intel is also shrinking parts of the business, cutting roles, reducing spending, restructuring operations. So now the big question becomes, can Intel meet booming demand after spending years downsizing? That's exactly what we're breaking down today. We'll talk about why Intel's business is improving, what the new CEO is doing differently, why cost cuts may create a challenge, Intel's debt situation, capital spending plans, and what all this means for Intel stock long term. So if you're bullish, bearish, or just watching Intel, smash that hype button and let's get into it. Intel's business is finally improving. Let's start with the biggest headline. Intel is seeing stronger demand. That matters because for several years, demand was weak in many key areas. The PC market slowed, data center competition intensified, margins were pressured, and the company was spending aggressively while revenue was under pressure. That is a dangerous combination. When revenue falls while spending rises, profits disappear quickly. That's exactly what happened. But now we're seeing something different. Demand is improving. Management is sounding more optimistic. Longer-term agreements are being signed, and Intel appears more confident about 2026, 2027, and beyond. That's a major shift, because when management teams start planning years ahead with confidence, it usually means customers are giving them stronger visibility. That's important. Why the new CEO cut costs first? Now let's talk leadership. One of the first things the new CEO did after replacing Pat Gelsinger was focus on discipline. That meant cutting roles, reducing costs, tightening operations, preserving cash, and improving efficiency. Some investors didn't like it, but let's be honest, Intel needed it. When leadership changed, Intel was in a very difficult financial position. The company had billions in losses, cash burn was serious, debt was elevated, and large investments were already underway. So the first priority wasn't expansion, it was stabilization. That makes sense. Sometimes before a company can grow again, it first has to stop the bleeding. That's what this management team appears to have done. Now, Intel has the opposite problem. And here's where it gets interesting. Now that costs were cut, now that operations were tightened, now demand is improving, Intel may face the opposite issue. Can they scale back up fast enough? That's the key question, because it's one thing to shrink a company, it's another to grow efficiently after shrinking. You need enough employees, enough manufacturing capacity, enough supply chain flexibility, enough equipment, enough execution. That's why this next phase of Intel's turnaround may be even more important than the first phase. Operating expenses are rising again. Now let's talk spending. Intel had previously targeted around $16 billion in operating expenses, but management now says costs are likely to be higher. Why? Three main reasons. 1. Inflation. Everything costs more now. Materials, labor, services, utilities, transportation, no surprise there. 2. Variable compensation. This simply means some compensation arises when business performs better. If sales go up, if production rises, then certain incentive costs rise too. And honestly, that's a good problem to have. 3. Targeted investments. This is the most important one. Intel is no longer only focused on cutting costs. Now they're spending to capture opportunity. That's a very different mindset. It means management believes returns on investment are improving. That's bullish. What are operating expenses? Beginner explanation. For newer investors, let's keep this simple. Operating expenses are the costs required to run the business day to day. Things like salaries, marketing, office costs, utilities, insurance, logistics, administrative expenses. These are recurring business costs. They help the company function today. So when Intel says operating expenses may rise, it means they're spending more to support stronger business activity. That's not automatically bad. It depends why spending is rising, and in this case, stronger demand is the reason. Capital expenditures are also changing. Now let's move to another major category, capital expenditures, often called CapEx. This is different from operating expenses. CapEx is money spent on long-term assets. Examples include building factories, buying chip manufacturing equipment, expanding fabrication plants, major infrastructure upgrades. These are investments designed to generate value for years. Intel had previously guided CapEx could be flat or even lower. Now, though, management expects it likely to be flat instead of lower. That sounds small, but it matters, because it means Intel now sees enough demand to justify continued investment. That's a positive signal. Why CapEx matters so much for Intel? Intel is not a normal software company. They manufacture chips. That means physical infrastructure matters enormously. You need fabs, machines, precision tools, massive engineering systems. And these are expensive, very expensive. But when demand is rising, those investments can generate huge returns. More capacity means more chips sold, better economies of scale, higher margins long-term, and better competitive position. So if Intel is willing to maintain CapEx despite past pressure, management likely sees real opportunity. Debt is still a huge story. Now let's talk about something many investors ignore: debt. Intel borrowed tens of billions of dollars during its turnaround phase. Why? To rebuild manufacturing leadership, expand fabs, invest in technology, modernize operations. But debt always comes with a price: interest expense. And when rates are high, that burden grows heavier. Now here's the good news. Management plans to pay down $2.5 billion due this year and $3.8 billion due in 2027. That's about $6.3 billion total over 2 years. And importantly, they want to pay it down using business cash flow instead of refinancing it. That is a very healthy sign. Why paying down debt matters. This creates what investors call a virtuous cycle. Here's how it works. Intel generates more cash flow, uses cash to reduce debt. Lower debt means lower interest expense. Lower interest expense means more future cash flow. More future cash flow means more flexibility. That flexibility can then be used for more R&D, more capacity, shareholder returns later, or faster turnaround execution. This is exactly the kind of progress long-term investors want to see. Can Intel really compete again? Now, let's address the elephant in the room. Can Intel actually compete at the highest level again? Because that's what many doubters still question. And honestly, fair question. Competition is intense. AMD is strong. NVIDIA dominates AI acceleration. TSMC leads foundry manufacturing. So Intel has no easy path. But here's what Intel does have: massive scale, deep engineering talent, global relationships, government support tailwinds, manufacturing assets, and improving financial discipline. That combination means Intel should never be counted out. Turnarounds take time, but they can happen. What does this mean for Intel stock? Now, let's talk stock implications. If Intel can combine rising demand, better cost discipline, debt reduction, stable CapEx investment, and stronger execution, then sentiment can improve dramatically. Because Intel stock has spent years priced for skepticism. When stocks are priced for low expectations, even moderate improvement can move shares significantly. That's how turnarounds often begin, not with perfection, with progress. Risks investors should watch. Of course, no stock is risk-free. For Intel, watch these risks. Execution risk. Can they actually deliver products on time and at scale? Margin pressure. If spending rises too fast, profitability may lag. Competition. Rivals remain extremely strong. Cyclicality. Semiconductor demand can shift quickly. These risks are real, but that's why valuation and patience matter. My honest view. Here's my honest take. Intel is no longer just a broken giant. It is becoming a recovery story. Not fully recovered, not guaranteed, but improving. And sometimes the market waits too long to believe recoveries. That can create opportunity. If management executes over the next few